So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to The Daily Call. Today we're going to answer the question, how do you make money selling options? I think this is one of the biggest questions that many new investors ask. In particular, many new options traders ask, is how exactly do we make money on a consistent basis, generating income for our portfolio by selling options? So there's a couple of bullet points I want to go through here that I think touch on a lot of the big rocks that we talk about in our strategy. So the really important things that you have to master. And in many regards, if you master these couple big rocks, these really important key concepts, everything else should generally fall into place, or it should be a lot easier to generate money selling options. Now, as we go through these, I want you to continue to remember or reference the concept of both the casino business as a casino owner and the insurance company business as, again, an insurance company owner. Because the options trading market on the options selling side is very much like those two business structures. There's a lot of overlap and a lot of similarity. And it's no wonder why, in many respects, Warren Buffett is one of the biggest options sellers and single individual biggest options traders in the market, because he does option selling strategies, which many people don't know. And he publicly discloses all of this in his quarterly and annual reports for Berkshire Hathaway. Now, that also means he does this because he's also in the insurance business. So he sees the value in this type of framework and this type of philosophy, not only in the equity markets because he's selling option premium outright, but also in the insurance business because he's selling insurance, which is very much the same thing. So the way that we make money selling options is purely by getting paid the volatility premium. So if I could narrow it down to one thing, the thing that makes money, the edge that we have in option selling is the volatility premium. This concept that when options are priced on a forward-looking basis or future value basis, they are priced assuming that the stock makes huge moves. But the reality is that the stock on a consistent basis will not meet up to those expectations or outperform those expectations. So to put this in hopefully better terms, if the stock or if the market participants are expecting that the stock is going to move 10% over the next month, we may actually see that the stock only moves 8%. And it's the same concept that insurance companies use with actuaries and with probabilities and death rates, etc. They basically assume that people are going to get into a car accident or their house is going to burn down many more times than actually might happen in reality. And so they base all of their insurance premiums, all of the money that we pay as individuals to insurance companies to insure our stuff, they base that off of higher expected default or higher expected fire or crash rates or ratios than what might actually happen in reality. And that difference, that premium, is where they make their money. So as option sellers, we are selling options and taking in this lower payout that most people don't want to take in. But in exchange for doing that, these smaller premiums on a consistent basis, we have a much higher probability of success. So it's, again, very similar to a casino or to an insurance company. Casinos will take in small, basically I call them donations, but they take in small bets, and every so often they might have to pay out a jackpot, but it never overshadows the small bets that they take in on a consistent basis. With insurance companies, they take in small amounts of premium. Maybe you pay $200, $300 a year for your car to protect it against a crash. And every so often, people do get in a car accident, unfortunately, and the insurance company has to pay back the value of that car. So $30,000, $40,000. But it never overshadows the small premiums that they collect across the board. So if we use this analogy then and kind of continue moving forward, then the next logical step is that in order for this option selling system to work, to make money selling options, we have to stay overall neutral in our portfolio. We have to not be directional traders in the US equity markets. Now, it's easy for insurance companies and for casinos to be neutral, right? Because every game is an individual occurrence and outcome. In the equity markets, We have trending markets and we have sectors and industries that we have to hedge against. And so one of the ways that we do this is by selling options on both sides of the market. So selling put spreads and puts and selling calls and call spreads. And this keeps our overall portfolio neutral to any expected move. I think this is one of the coolest things that we can do as options traders that is totally unique in our business, in that we have the ability to very quickly, on literally an hour or daily basis, reestablish new positions based on new information. There's no other business on the planet where you can actually change the entire business model or potential payout as quickly as you can in the options industry. So if you're running a restaurant, you can't just close the restaurant and move it across the street if you get new information that, across the street has better traffic for that restaurant. It's really hard to do. But in the options market, if the market starts moving down, well, we can move all of our positions down to compensate for that accordingly. So staying neutral is one of the key concepts to making money selling options. The next one that we have to talk about is keeping position sizes small. So if we think about, again, insurance companies and casinos, they don't just gamble with one person. They don't just insure one person's house. Insurance companies and casinos know the value of small, manageable risk positions. That's why they try to insure hundreds of thousands of people. That's why casinos try to get hundreds of thousands of people into the casino to play. It's not just one table at the casino. If it was more profitable for the casino just to have one table in the casino, then that's what they would do. But it's not. They have to keep lots and lots of small positions going at all times so that no one single person or one single position could ever knock them out. And this is a key concept that many traders don't understand. They try to over allocate with their position size. But when you do this, you run the risk of one single bad trade or a single sequence of trades knocking you completely out of the market. So we have to keep our position sizes extremely small. And then the next step from there is we have to play the expected values. So if we understand that we got to stay neutral, we understand that we have to sell premium, then we have to, the next logical step, play the expected value game, which means that we have to do this on a reoccurring basis so that we increase the number of frequency of trades or occurrences of trades or high number of trades in order to hit some sort of expected payout. Again, if you think about an insurance company or a casino, none of their business models work if they only insure people, and they insure a lot of people, but they only do it for 1 year. The model may not work in a single given month or year or quarter because they may have at any one period of time a sequence of returns that is not what it should be. It's like flipping a coin. If we expect to flip a coin and hit 50-50 heads and tails, we may run into a sequence of 10 heads in a row when we flip that coin. Now, that's not the expected outcome, but we may run into that string. So when you're trading options, you may run into a string of losers. You may run into a string of winners, but it's only where the income in the portfolio really solidifies itself is when you start trading and reaching higher trade counts overall, because then the expected value starts to gravitate more towards its true probability. And that's where you get a lot of stability in your account, you get a lot of stability in your income, and it actually makes this entire thing so much easier. So hopefully this helps out. I've tried to condense it down into what I think are kind of the top things. I'd love to hear what you guys think. If this was helpful, please let us know. Share us online, like us, thumbs up, do whatever you need to do to let us know that this was really helpful. And as always, if you have any questions, let me know. Until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.